Good afternoon. My name is Don Vivrette. This is a redo of the week 4 It's Your Money series because I made a mistake and did not turn on the video at the beginning. So we're going to do a redo of the front half of this. I'll go through the beginning of this, and then Pete and Laura will come on and they will do their part up until the time where it was actually recorded. So there'll be a splice in where that will come in. But I wanted to cover a couple of things with you here while we're here. Process, as you know, how many people, 300 of you are registered, 200 of you are overlapping. There will be no question and answers in this particular recorded session because we've already done it live for us. And incidentally, the questions that were asked, we are bringing over into this particular video. So you will hear answers to some of your questions that you had because we already knew what they were. This recording will be available soon, probably this Saturday. It's currently Thursday. And we will have those available and you'll be able to watch them. The question has been asked, and I'll bring you into here, how long do these materials stay on the site? I'm going to believe that they will be there at least until the spring. Some of the videos and some of the material here are actually very old. So they will be here for quite a period of time. They do not go away quickly. There was a question asked in terms of what was going on with the various sponsors. You can click on the various sponsors and it will show you the link to their websites. Today we are doing the financial planning number 2 session, investing your money. That's the process we'll go through now. Next week we will be talking about medical care planning, and that's, for some of us who are a bit older, a very critical area for us to take a look at. Normally, we are physically in locations. These are the locations that we normally would be at. We wanted to thank them for the times we have been there and dearly hope that in the spring that we can be together in reality rather than virtually, because it's so much better doing this live. These are the participating charities that we've had over the years. Chapman University, shout out to them as always, of 10-year sponsor, which is a very significant thing for us to have them doing over all of these years. Typically what we have is the charities come in and speak to the groups in person, but clearly that's not being done this time. So in this particular case, we had videos made of them or with them to be able to provide information for you. So at this point, in defense of animals, I'm going to turn off my camera and my sound, and I'm going to bring up that video. Hang on.
No life is insignificant. Whether big or small, long or short, each and every life matters. As citizens of this planet, these are our fellow passengers aboard this pale blue dot. Since 1983, In Defense of Animals has championed life in its multitude of forms. We fight for animals. We fight for people. We fight for the environment we share. From the plains of the American West to the savannas of Africa, every dollar we receive from our generous donors is another step towards the protection of animals. Your participation is the hand that opens dog meat cages in South Korea. Your participation is the arms that cradle homeless cats in India and abandoned puppies in rural Mississippi. Your participation is the voice that speaks for the voiceless in the languages of compassion and empathy to erase the imaginary line that divides us and them. In the words of poet Mary Oliver, like us, they have a heart and a stomach. They know hunger and probably a little satisfaction too. Do not mock them for their gentleness. They have a muscle that loves being alive.
Good afternoon again. This is the beginnings of the technical part of the redo. And so Pete and Laura are going to go through and cover this one through slide 43, at which point I will splice in the actual presentation from them. So I'm going to go away and you guys go for it.
All right. Hi, Laura.
Hi, Pete.
Okay, let's go through this. Well, you just got through watching the Defensive Animals video, and Nicole, who's the Planned Giving Director there, is just excellent. And if you have any questions regarding any kind of animal organization, whether it's Defensive Animals or not, she will be happy to help you out. She's also an attorney, so she's familiar with all the planned giving techniques. So she's a great person to ask, as it's going to be next week or the week after with Dawn and David Moore. So we just love our charitable sponsors. We're not going to reintroduce Laura because we all met her last week, and we're going to continue on that. Just so you know, I did put some articles on our website for the materials section about white collar crime. White collar crime does pay, and it's because the financial services industry is very complex. Laura has served as a expert witness in a variety of cases all over the country. It is super complex, and it's not geared towards the consumer, whether it's annuities, hedge funds, etc., consumer finance, student loans, you name it. The other thing too is that our mission of financial and estate literacy is to prevent financial abuse. And white collar crime is very difficult to convict. Here in Orange County, white collar crime is, or financial abuse is one of the fastest rising crimes in the county. And you have to have a minimum stolen by your family members of $300,000 or more before you can even get the prosecutor in the county involved. So from my point of view is that the fee-only fiduciary advisors that we've been introducing you to and that Laura has trained, that we know are some of the best things against financial abuse, because in some families, children don't ever grow up to be financial adults. And so need to take that into consideration. So Laura, let's get started and where we left off last week.
Great. Thank you, Pete. Share my screen here. All right. Everybody see that?
Yep.
So we're going to jump into investment planning, and just one quick slide on annuities, because I know you had a week with a lot about annuities, but just, Pete mentioning that all of the expert witness work that I did, most of it involved annuities. It's the most litigated financial product out there, variable annuities and the index annuities. And there's some just crazy abuses, and the fee-only advisors rarely recommend annuities. So only the people who are selling them are recommending them. Professional advisors who aren't selling them usually would warn you to stay away from them.
Yeah, so, and just one quick point on that, Laura. There are some annuities out there that are being geared towards the fee-only advisor, but don't be sold one.
Right, those are usually used to get out of the bad ones and get into ones that aren't as bad.
Yeah.
Because it just, the tax, there's so many tax disadvantages to it. It's really hard to get your money out without a lot of taxes and fees. And they use words like guarantee and all those things that when you really dig down into them, they aren't what they say they are. I mean, I did a whole expert witness case about the language they were using in sales brochures where they were saying, well, fee doesn't mean fee, was the whole argument, with 14 lawyers from 5 insurance companies. And it's very, very tough to even figure out all the expenses that you're paying. But
I've stolen your line, Laura. Just say no.
Just say no. Yep, exactly.
Except I will, however, make one point about this. Next week, when I talk about charitable gift annuities,
Yes, different.
they are completely different. Commercial and charitable are completely different animals. So I will defend myself next week.
Excellent
There you go.
point.
I'm done.
Yep, that is the one kind of annuity that can make a lot of sense for
Yeah,
people.
it's a 2-page annuity. Nobody makes a commission. So charitable gift annuities are completely different than commercial annuities.
Good, excellent point. Yep. All right. So basic investment planning, you're going to have a whole session on equities or stocks, and you're going to have a whole session on bonds where you're going to get into a lot more detail on those 2 categories. But we're going to start with how you put together a portfolio and some of the considerations, looking at more the big picture of how you should approach your investments. So this is an approach that you've heard the term asset allocation. I think it's the way that most advisors are approaching investment management at this point. Not everybody, there are different ways of doing it, but this is probably the most well-accepted approach where you really look from the top down and you figure out how you're going to split your asset classes before you dig down into those asset classes and figure out which stocks, which bonds, and the other parts of that. And it's all based on modern portfolio theory, which goes back many years now. And the idea is that the biggest determinant of your return is how much you have in different asset classes. It's not whether you pick the right stock. It's how much in stocks and how much in bonds, and then going down to the next layer, what kind of stocks, large ones, small ones, value ones, growth ones. So we're going to get into that, just looking at some of the big picture considerations, which is really how you should start to look at this before you, again, figure out the individual components of your portfolio. So basic asset classes would be cash and equivalents, bonds, stocks, and then anything that's not a cash or stock or bond. And that would be the alternatives category, which is something that's relatively new in the last 20 years, that's considered possibly a basic component of your portfolio. So we'll dig into each of these categories a little bit. So cash and cash equivalents, generally anything where you're not at risk of losing your principal would be in this cash category. All these are very safe investments as far as no risk of principal loss. It could be a CD, it can be a treasury bill, it could be just a cash checking account. A money market fund is in this category. And there have been times when there's been some slight risk in money market funds where they break the buck basically, and the money market funds aren't worth $1 a share. That's very rare, and those are some of the riskier money market funds that have been paying yields higher than the market yields. But you really should not have to worry with money market funds either. The risk that cash has is risk of not keeping up with inflation and low yield. Right now, there's no yield on cash. I think, bank accounts may be paying 0.01% or something. There's just virtually no yield on cash right now. But cash has a place in a portfolio for savings and short-term spending needs. It's not a good long-term, it's not good to have too much in cash for your long-term strategy, but it can be a piece of your portfolio for processing distributions and so on.
Liquidity is important in investment planning, isn't it, Laura?
Definitely. And that's a really good overall concept to think about. It's don't lock up your money unless you absolutely have to. And that even goes for, some of the CDs and all, locking up your money, especially in this environment, it doesn't pay so much. And we'll get into that when we talk about fixed income. But a lot of the investments that would fall into the alternative category, and even annuities fall into this too, where you really can't get your money out, you don't have liquidity. And so, you know, we feel very strongly, you know, liquidity always has such a premium, and you really have to be paid well to lock up your money in anything. And usually the things where you're locking up your money, the investments that aren't cash investments have more risk also. So the next step up on the risk ladder is bonds, and bonds are where you're giving money to either a company, a corporation, or the government in exchange for an interest rate payment. So very safe. Generally, there's a range of safety on bonds, and there's different bond ratings that you'll learn about when you have the fixed income session. But generally, if you buy an individual bond, you get your money back at maturity, and along the way you get paid interest. And they can be, as I said, company bonds, which would be taxable interest. They could be municipal bonds where you're investing in infrastructure projects. They can be treasury bonds. By the way, muni bonds, like California muni bonds, where you're investing in California, either general obligation bonds or projects, are tax-free in California, also federally tax-free. And treasury bills are state tax-free, but not federally tax-free. And bonds have risks as well. If you buy an individual bond, you will get your principal back at some point at maturity, but in between that time, you have market risk and all kinds of other risks. If you buy a bond mutual fund, it's similar, but there's no maturity date where you're going to, you know, get your money back. You can buy and sell that fund at any time, and those funds have risk too. So you have to be sure you understand what kind of bonds you're investing in. We'll talk about the degree of risk, but you have risk of keeping up with inflation. You have interest rate risk where interest rates move, and you have market risk. So bonds trade on the market just like stocks do. And you have, if you're buying corporate bonds, you have the risk of company performance. That'll affect what you pay on bonds.
You know, one of the, Laura, one of the risks that you don't have listed is predatory risk. And what I mean by that is are bonds just as easy for a consumer to purchase as stocks? And
yeah, so bonds are not as easy to purchase. Individual bonds are not, and there's the pricing is not transparent in bonds. And when we talked, the question often comes up like, how big is the bond market? And the bond market is actually bigger than the stock market. I actually had the numbers on that. The U.S. stock market currently is about 30 trillion in value, and the U.S. bond market, including corporate bonds, treasury bonds, agency, and money markets, is about 40 trillion. So the bond market's huge, and there's a lot of companies that specialize just in trading bonds. And if you answer some of these ads where they're offering a high yield on bonds, a lot of times those are teasers, and they try to kind of reel you in with those rates, and the rates on bonds change just like the stock market, moment to moment when the market's open, and you can't see what you're paying for that bond. It's built into the price.
So when a consumer is purchasing a bond, use extreme caution.
Yeah, and if you're buying a bond for $5,000 or $10,000, you're probably way overpaying for it. You need to be buying bonds, if you're buying individual bonds, in usually $100,000 increments. And you may be working with a money manager who's buying a big block of bonds and then parsing them out into smaller pieces to different clients. But just be very careful buying individual bonds. So bonds are bond prices are directly impacted by interest rates. And in fact, bond prices move inversely to interest rates. And this is a chart going back to 1927, I guess, showing in the purple, the bond prices, and then in the blue, the bond yields. And as the yields go down, the value of your existing bonds goes up. So now that we're in a period with practically zero interest rates, the likely direction of interest rates in the next decade is up, which means there's going to be downward pressure on bond prices, because if you buy a bond today, if you buy a 3% corporate bond, and in 5 years, corporate bond yields have gone up to 6%, if you want to sell your bond, it's going to have to be discounted, because people can go out into the marketplace and buy a 6% bond. Why would they want your 3% bond? You're going to have to sell it for less than you bought it.
Good explanation.
If you hold it to maturity, you'll get your money back. But if you try to sell it in between that time period, you could take a hit. And that's likely to happen because interest rates aren't going to go down a lot from here. They're not necessarily going to go up real quickly. We don't think that, I mean, the Fed has said they're not raising interest rates for a while now. So we think things are going to be pretty steady where they are. But there's just not going to be a lot of principal appreciation in bonds. And there's been great principal appreciation in bonds since, that the blue is up at a high in the early 1980s, when mortgages were 14% and money market funds were paying 18%. That was the time to buy bonds, and a lot of people made a lot of money in bonds, and a lot of so there's some famous bond investors here locally who did very well during that time. And there's certainly a lot of art and skill to managing bonds, but it was a pretty easy money market to make money in, as yields went from 18% to zero. It was hard not to make money in bonds during that time period. Now it's much more challenging. So there's different ways of addressing that. You can go outside of the United States to get higher yields. You could invest in some different types of bonds, but you want to be careful not to get too risky with your bond investing, and you want to diversify the types of bonds too. So just again, to drive home the potential risk in bonds, you usually can get a higher yield by going farther out on the duration or the maturity scale. So, in a normal environment, a 2-year bond might yield 2% and a 10-year bond might yield 6%. But rates are so low right now across the maturity spectrums that the 30-year treasuries like 1.6% interest. So it's not worth it to tie up your money for 30 years to get less than 2% return. And also, if interest rates do go up, your longer term bonds are going to take a bigger hit. So this shows it in U.S. Treasury bonds. If a 2-year Treasury bond when you have a 1% increase in interest rates could go down about 2%. The 30-year Treasury could go down almost 20% in value with a 1% increase in interest rates. So it's very risky to go out too far. And right now you don't gain anything from it. So we're keeping maturities more like 5 or 6 years with our bonds. You get a little bit more going out farther, but you don't need to go out too much farther than that right now.
Laura, we're going to have an entire session on bonds, but for the audience, I think it's a great idea if you looked at your own portfolio and to see what your maturity or duration is on your bonds, because you just heard Laura say that in their portfolio, she doesn't go out any further than 6 or 7 years at maximum. And that means probably when you go out to 6 or 7 years, that's not the bulk of the bond or the fixed income portfolio, I would assume.
Right. No, it's not. Now I'll show a breakdown of how we would build out the bond portion of a diversified bond portfolio. And in some markets, we might use individual bonds, and that when you do that, you would normally ladder them, meaning buying different maturities. So if you buy one, 3-year, a 4-year, a 5-year, 6-year, every year as a bond comes due, you're buying a new one at the higher interest rates if you're riding up an interest rate curve. And that's a common way to invest in bonds. But right now, with rates so low and there's not really a curve to ride up, we're using bond mutual funds, relatively short-term bond mutual funds right now.
The moral of this slide then means is that if you're out more than 7 years, you're taking an enormous risk.
Yep, because we are, we're not going to be declining much from here in interest rates. I mean, the direction is going to be, either flat or eventually up in interest rates.
Okay, and that leads me to my next question is that is fixed income with the low rates, what purpose does it serve in a portfolio?
That's a great question. So we say it's the ballast, it's the safety part of the portfolio. We like to have enough in cash and fixed income investments in a portfolio to provide several years worth of spending, so that if we hit a bad stock market cycle, when we hit a bad stock market cycle, we're not forced to sell stocks into a bad market to provide living expenses. So we always have enough in cash and fixed income so that we can tap into that, because it's much more stable and the prices don't move as much. So it's for the stability in the portfolio. Most everybody should have some bond allocation in their portfolio.
Okay, thanks,
So,
Laura.
Yep. So stocks, it kind of the opposite of bonds. You're owning in a company. I say every investment, you're either loaning your money to someone or you're owning. With bonds, you're loaning your money. If you're investing in a CD at a bank, you're loaning your money to the bank in exchange for an interest rate. With stocks, you're not a loaner, you're an owner. You have a piece of ownership in a company. If you're buying a mutual fund, you have a small piece in many companies. And as an owner, there's more risk and there's more potential return. So that's one way to look at stocks and bonds. And ideally, you have a balance of both in your portfolio. So if you're buying individual stocks, you actually can vote as a shareholder for actions with the company. If you have a mutual fund, you also vote on the mutual fund. And we'll talk about a mutual fund a little bit, how you can buy into stocks without buying individual stocks, which we think is gambling, basically, buying individual stocks. That there's smarter ways, I think, for most people to invest in the market long term. Stocks have inflation risk as well. They have principal risk, even more so than bonds. The market risk of the market going up and down, which is the thing that most people are watching. And then, the company performance risk, how the company performs certainly affects the stock price. So the challenge is putting these risks into perspective and figuring out how much risk you can afford to take and that you're comfortable with taking. That's the key to building a portfolio, and tying that into what kind of return do you need to get. Most people don't have enough money to where they can get no return. You have to get some return, and you're going to get the most return from stocks, but you have to balance that with the risk that you're going to take.
And that comes into last week's presentation when you were talking about what's your net worth, what's your cash flow, what liquidity do you have, how much other income do you have before you can even get to how much stocks do you need in your portfolio?
Yeah, and if you have a pension or you're going to be receiving a pension, again, they're rarer and rarer these days. But if you're getting a nice sizable pension, that's kind of like a guarantee. It is a guaranteed, almost like an annuity, fixed income type of investment. You might be able to take more risk in your portfolio than if you don't have that kind of stability.
All right, is the stock market versus the bond market more transparent?
Yes, the stock market is more transparent than the bond market. So the stock market is very transparent, and that's one of the reasons that we prefer indexing versus trying to beat the market, which we'll talk about in a minute. Because the stock market is transparent, all the information pretty much is out there. You really can't get, especially as an individual investor, you can't get information that other people don't have to kind of beat the market and outsmart the market. That's been proven over and over again that even professionals with lots of resources can't consistently beat the stock market because there's so much information out there, unlike the bond market.
Let's go to the next slide. Yes.
Alternatives, completely different. And alternatives are anything that's not a stock or bond investment. And the idea with alternatives, why you would want to include them in your portfolio, is it's a diversified source of return, where if the stock and bond markets aren't doing well, alternatives might be doing well. they are not correlated with the stock market or the bond market. And, and the bond market and the stock market are not inversely correlated all the time either. They don't move in opposite directions all the time. It's not.
So in your portfolio, you want non-correlated assets in that portfolio, and you want it to be diversified, because those are two terms of art, I believe, when you were talking about investments.
Yeah. So diversified it means a lot of different things. So when we talk about stocks being diversified, it doesn't mean you have, Microsoft, Alphabet and Apple. That's not diversified because they're all in the same sector. They're all large companies. Diversified means small companies, large companies. We'll get into that a little bit more here, but and then diversified across asset classes. And then non-correlated means that some of your asset classes in the portfolio move in opposite directions. So commodities don't move with the bond market or the stock market in the same direction all the time. All of these assets don't necessarily move with the market in the same direction. That's, we spend a lot of time trying to find assets that are very uncorrelated with the stock market. Reinsurance is a market, that Warren Buffett made so much money in, that is completely unrelated to what goes on in the stock market. It's more related to what happens with, the weather and other things, not the stock or bond market. So that would be an uncorrelated asset. Real estate is an uncorrelated asset that doesn't necessarily move in sync with stocks and bonds. It would move more in the direction of stocks, but not always. Hard assets like gold, we get a lot of questions about gold. We don't include gold in our portfolios. A lot of advisors do. There's a lot of reasons we don't. It's not an income producing asset. It doesn't behave the way you would expect it to behave all the time. It's had a good year, but over long time periods, it significantly underperforms the stock market. But some believe in that. I think it's become less and less of a hedge when things aren't going well. But again, there's a difference of opinion on that. And then private equity and venture capital, higher risk areas that you probably don't even want to think about unless you have a very large portfolio. But the other thing about this, in not even 10 years ago, almost all of these assets could only be invested in partnerships and LLCs or directly in very illiquid forms, and that alone increases your risk. And almost all of these assets now can be purchased in more liquid forms, maybe some limited liquidity, like quarterly liquidity or annual liquidity, which is great, but still can be. A lot of these assets are places where you could lose all your money. The stock market, you're not going to lose all your money. In these kind of assets, especially if you get into a private partnership and you think you've done your due diligence on the providers, and a lot of times these things do go under. This is where a lot of problems can take place. So it's a risky area, and just be careful here.
When you do when you invest in alternatives for your clients, Laura, do you say, hey, I want you to have a minimum amount of assets first before you look at alternatives, or would you recommend that? That's one question. The second question would be, what percentage of your asset allocation should you look at in investing in alternatives?
Yeah, so I wouldn't normally put more than 20% in alternatives. For most people, I think we're typically 15 to 20%. For clients who have, a lot of assets, may have a higher percentage here. And I don't know, probably $1 million portfolio before you go into these. Though if you're buying them through a mutual fund, it's a little different. So even a smaller portfolio, it might make sense. There's some REITs, some real estate investment trusts that you can get into in a mutual fund. And there's, commodities funds that, in a smaller portfolio could make sense. So
these shouldn't be the main driving force of your portfolio.
No, and actually, it's interesting because we do a ton of research here. And we have clients who are buying into these assets through direct partnerships and all. But the jury's kind of out on how well this strategy's worked over the last 20 years, having these alternative non-correlated assets, because the stock market does really well over time, and it's really hard over a long-term period to beat the stock market. And so we invest in alternatives, not really even so much to get higher returns, but to have, as I say, non-correlated assets. So if we went into a long-term downturn in the stock market, we expect these assets to do well in those periods. That's the type of alternatives we would be buying.
Let's go to the next slide.
So digging down into stocks a little bit more. So a diversified portfolio, as I said, isn't all the same size companies or the same sector companies. It's all different types of companies. So there's different ways to break stocks down. First of all, domestic versus international. Most of the domestic the US stock funds have companies that have a lot of revenue coming from international sources. So these lines have blurred over the years. So, the US big companies, by some measures, get more of their revenue from outside the United States and inside the United States. So you have some international exposure if you're buying large company stocks, but you can get more direct exposure buying directly into international funds. So they're fairly well correlated, the domestic and international, but not always. International have done worse than US stocks the last few years. So, there's time periods when international outperforms. So I think
international is broken up into what, two major categories?
Developed international and emerging markets international.
And emerging is, of course, higher risk.
Yep, higher risk, higher return.
Yeah,
over time.
And,
so
and again, what percentage of your portfolio what range, I guess, of percentages do you look at?
So I see advisors going, 10 to some 40, 50%. Okay. And I say a lot of the endowment funds and big institutions look at the world market when making their investment allocations. So they put a large weighting on international. We are more US weighted because we feel like that's the best market in the world overall long term. Also, that's where we are. That's our frame of reference. We typically have 15 to 20%, I think, international. Have occasionally gone to 25% maybe. Probably, okay. Say international have underperformed, though, you can't necessarily time the market based on that, but, maybe due for some outperformance.
Growth and value. What does that mean?
So growth and value, every stock can be classified as a growth or a value stock. Growth stocks are stocks that are growing a lot and not normally paying dividends. They're reinvesting their earnings back into the company, versus value funds, which are some of the more old, unloved companies that you may be able to buy at a bargain. They are slower growers, but maybe paying a higher dividend, for example. The market runs in cycles for growth and value as well. And the S&P 500, which is, the best, most common measure of, the overall stock market in the large company sector, is by definition half growth stocks and half value stocks. And the value and growth stocks are defined based on whether they are above the S&P average in the growth metrics or below the S&P average in the growth metrics. So stocks can move from a value to a growth stock, but typically tech stocks are growth companies. Consumer staples would be value companies. Utilities are value companies. Long term, 80-year history of the stock market, value has outperformed growth, but the last 10 years, growth has significantly outperformed value. There are investors who are strong value investors. Again, Warren Buffett being the most famous one. You buy value companies, you hold them forever. You try to buy them at a discount. That strategy's been painful the last 10 years if everything you have is in value funds, because the underperformance is extreme. I think over 10 years, growth stocks have been up about 14% annualized, and value stocks 8 to 10% annualized. So growth has significantly outperformed more than normal. And lots of people think that it's about to invert. Other people argue that the things have changed in the markets and the world to where there's some reasons that it might not invert. We don't even try to make a bet on that. We invest in both, and we don't try to time it or call it, which has worked out well. Well, companies don't usually put everything in growth, but many investors do try to focus more on value. So if you buy the S&P 500, you're getting a pretty perfect blend there. So small cap versus large cap funds, this year, large companies, the S&P 500 is up about 9% year to date, and small companies, all the small company indices they're down about 8%. So huge divergence there in return. So a lot of people are saying, how could the stock market be doing so well? Well, the whole stock market isn't doing so well. International's not doing so well. Small companies are not doing so well. Mid-cap companies are not doing so well. And you can't predict that year to year. That's also been quite a run with the large companies, all the big, driven by the big tech companies largely. They've outperformed quite a bit for a few years now. But again, longer term, small and mid companies do better over long periods of time. So at some point that will probably normalize in a different market cycle. So we definitely feel like you should have small companies in your portfolio and even mid-sized companies. So we break mid-cap out separately. Some firms just do small and large. We think mid-cap's a great sector. It's often been the top performing sector out running both small and large. And so what do I mean by small cap and large cap? It's the value of the companies. So a large cap capitalization company is a company that's worth, generally, there's different ways to measure this, but the most common would say that large cap is companies that are worth 10 billion or more. And so what you do is you take the outstanding number of shares times the share price, and that gives you the market cap or the value of the company. So small companies, usually less than 5 billion.
So the issue here from this slide for individuals who don't know how their portfolio is diversified, you need to take this slide and take a look at your own portfolio and put a percentage. What percentage of my portfolio are in growth stocks? What percentage are in value stocks? What percentage do I have in small cap, mid cap, large cap? And if you own a mutual fund, it'll state in the mutual fund what kind of manager and how they invest in their portfolio. Can you compare performance-wise one manager who does small cap to another manager who does large cap?
No. You have to compare in the same category, because if you want a diversified portfolio at any given time, something should probably be down. Okay. And small cap's been down, but that doesn't mean you should give up on small cap.
Okay. And we're going to be talking about all of this in the equity session in much more detail.
Yep. So just want to talk about active and passive investing. Active is a term for people who believe that they can beat the market, that they can pick the stocks that are going to be the winners. Used to be kind of the only way of investing in the market until John Bogle and Vanguard came up with passive investing, which is where you buy the whole stock market, you buy the index, you buy the S&P 500, or you buy the small company index, or you buy the international index, and just invest in everything, because the belief was that individual investors and professional investors could not beat the market over the long term. And we started doing this in the early 2000s, and we started investing passively, and it was very controversial at the time. And now it's the preferred way. Really, more money is flowing into index funds, passive funds, than active funds. So it's more accepted, though there's certainly the industry's driven by people and managers that think that try to beat the market. And every year some do. But the numbers are pretty astounding, between 70 to 92%, depending on which category, international, large, small. The majority of professional investors do not beat the market index. And there's just a ton of research on that. That's certainly what we believe. And so we spend more time on that asset allocation decision, deciding on how much in small, how much in large, value, growth, international, rather than trying to pick stocks or even pick mutual funds. So passive investing is another word for indexing. This is a firm I've mentioned before, DFA, which stands for Dimensional Fund Advisors. They're a big passive investment firm, and actually they're value focused also, but they call it evidence-based investing because they think passive is a negative term, that, based on evidence that you can't beat the market. So, but passive is the same as indexing. Just a quick thing on ETFs versus stocks versus mutual funds. I know you'll get into this a little bit in the stock session, but ETFs are exchange traded funds, and ETFs were created around the turn of the century. And they were initially created to buy the index, to invest passively. Now ETFs come in all shapes and sizes, and there's active ETFs and non-transparent ETFs, but the core ETF market, most of the market is still index-based investing. And an ETF is a fund that trades like a stock. And why that's different, just a stock trades intraday, price varies all day long, people buy and sell. A mutual fund is priced at the end of the day. So whatever time of the day you buy into a mutual fund, you're going to get the same price. After the market closes, they add up all the stocks held by the mutual fund, and that's divided by the number of shares, that's going to be your value of your mutual fund, price once a day. ETFs, exchange traded funds, are funds, groups of stocks, but they trade intraday, which is kind of neither here nor there. It's like you don't really want to be actively trading them necessarily, but that's what a lot of people do.
Let's go to the next slide.
Yep. So this is a pretty famous chart. Love this chart. And there's a version of this chart that has all the huge crazy events that have happened in the world superimposed on it, like the Great Depression and the Cuban Missile Crisis and the
World War I, World War II.
Yep, everything. So throughout a bunch of bad stuff, the market prevails. The market does well. And I am such a believer in the market as the best place to build value with liquidity, and through the ETFs, the exchange traded funds, you can buy into it so cheaply. That's one of the benefits of ETFs over mutual funds. Somebody had asked a question about that. Mutual funds have higher fees. ETFs are much lower cost. You can get market exposure very cheaply and tax efficiently. And long term, if you don't, freak out and sell at the wrong time, you're going to make money in the stock market. So
your people are investing in capitalism.
Yeah, and the United States is still the place to be largely. There's a lot of opportunity around the world, but we're still right now the best market to invest in. And there's this lot, obviously tons of talk about what's going on, and a lot of businesses are going out of business, big and small, right now this year. But tons of new businesses are being formed, and things shift. A lot of trends that were already in place have just been accelerated by what's gone on this year, especially in technology. We've kind of leaped forward several years faster than we would have if we didn't have this pandemic, and there are companies benefiting from that. So there's always opportunity. The markets adjust to whatever goes on. So long term, 10 to 12% in the stock market. And I say that beats, real estate over any time period, any geography, certainly bonds by a long shot. So,
and is risk associated with return?
Yes. So well, you know, it's interesting because you look at these lines and they're all pretty wiggly. The small company is a little more wiggly than the large company. So there's more risk in those to get that return. You do see the treasury bills, there's no wiggles there. You know, it's a pretty straight line. There's not a lot of volatility there, but government bonds have some more volatility. So yeah, more risk, you know, the more wiggly, the more return. And ideally you've got a portfolio that's balanced and the goal being to at least, you know, be beating inflation by a reasonable amount and after tax also. So
let's go to the next slide.
So so reduction of risk over time. This just shows, again, you can't expect that you're going to get those returns in any 1 year period. And we have clients ask all the time, you know, I got $300,000 from, you know, this house I'm selling, and, you know, I'm not going to need it for a couple years, you know, how should I invest it? And we would tell people, if you need that money in 2 years to buy another house, you should put it in, you know, a money market fund, probably maybe a short-term bond fund, but don't invest it in the stock market. You need to invest and plan to be in there for a longer period, at least 3 years, if not 5 years, because the longer you're invested, the less risk you have of having a down year. So in any 1 year period, small cap stocks could be down 60% or up 130%, crazy. But over a 20-year period, you're always going to have positive returns that are higher than the other categories, for example. So the longer you're invested, you know, the more your risk goes away. And that's, you know, that's what I feel a big part of our job is as advisors, is to really keep clients focused on this longer term. And, you know, I'm very comfortable that long term, you're going to be okay in a diversified portfolio. You're going to do well in a diversified portfolio.
And stay disciplined.
And stay disciplined. And even if you are retired and you're older, you know, you need to have your money lasting. It's not like you need all of your money on one day. You need it to be there over time. And it's, you know, what you don't spend, you're passing on to somebody. So keeping it invested over the long term makes a lot of sense. You want to be more conservative for sure once you stop adding to your nest egg. But you don't need to go all cash or all bonds. I think everybody should have some stock market exposure over time. Again, this is to the argument of diversifying among asset classes, not just a bunch of different stocks or a bunch of different funds, but in all these different categories. That top row is the top performing asset class for that year, and the bottom is the bottom. And if you invest in a diversified portfolio, you're never going to be at the top, you're never going to be at the bottom, but you'll be in the middle. And that, you know, that's what most people should be aiming for and would be pretty happy with. And, you know, you get into that trap of thinking, you know, you're in a period where things have changed dramatically. And it's interesting because this chart doesn't have the value in growth. And I think, you know, there's some interesting discussions around that because growth is one for so long. But, you know, sometimes it's a long cycle and things change. You just don't know. And anybody who thinks they can call it year to year, it is, you know, nobody can. Somebody out there will get it right every time, and they'll have a big following. And if they manage a mutual fund, a lot of money will come in. And, you know, I've been asked, looking at this chart, you know, what if you took the lowest performing thing and invested in that, you know, at the beginning of each year? It works out a little better than taking the top performing, but, you know, not much. I mean, you're just way better off just mixing it up kind of equally and just rebalancing and letting it ride. So first step is determining which assets classes you're going to include. Stocks, bonds. Are you going to try to do alternatives? And then make a pie, and then implement, rebalance, and evaluate performance, and be obsessive about taxes. So that we'll talk about that here in a minute on rebalancing. So these are 4 general models that I think are pretty standard in the industry. I think this is how Vanguard splits up their portfolios. So stable, conservative, moderate, and growth. The purple is the amount in
Equities, stocks,
bonds, and the blue is the amount in stocks. So moderate growth is, you know, the standard. We call that the 60-40. You'd always say the stock percentage first. So 60-40. And that sometimes is also known as the endowment model, that 60-40, though endowments do all kinds of other crazy things with some of the alternative assets. And some have done really well with that, and some have lost a lot of money doing that. But if you stick to these basic splits, you know, that's going to be a good way to go. So the rates of return for these different portfolios, typically, when we look at the returns, historically, the returns have been higher than we will tell people we expect them to be going forward, because of the huge bull market we've had in bonds, where interest rates went from 18% to 0. So returns over the last 20, 30 years are unreasonably high because of the bond market doing so well. And now where we are in the bond market, we don't think you're going to get 8% out of bonds for the next 10 years. So we have tamped down what we tell people to expect in these portfolios. We expect stocks to do similar over the long term, but bonds over the next 10 or 20 are going to be much more challenged. So a stable portfolio where you have 80% in fixed income and only 20% in stocks, we would say that's a 4 to 5% return over time. Conservative would be 5 to 6, moderate 6 to 7. And growth of 8% plus. And you know, those are the numbers that we use. We use these numbers because we plug that into our financial plans. So if we have a client who's investing for moderate growth, which is normally when someone stops working and adding to the portfolio and they have their nest egg is what they have to live on, we really, in most cases, don't want them in growth. We want to be in moderate or even conservative if they're a little more risk averse. And so, those returns we'll use to plug into the portfolio. So if we have a moderate growth client, if they're drawing from the portfolio, we might use 6% return in our projections. If they're not drawing from the portfolio, but they're living on a pension or Social Security or other assets, we might use 7%. So those numbers are used in the financial planning too. So we need to know, you know, we haven't even talked about how the taxes factor, but you know, not only do we need to know everybody's tax rate and how their assets are split, we need to know, you know, are they drawing from that? What are their sources of income they have? If all your assets are in tax deferred accounts like IRAs and retirement plans, it's a very different outlook than if you have no assets in there, because those are assets that haven't been taxed. So that has to be taken into account. It's good because you can do whatever you want in that portfolio and not worry about the tax effects of rebalancing, et cetera. But it's not good as far as, you know, every dollar you pull out to spend is going to be taxable from an IRA account. So it's nice when you have a mix.
Laura, but where does age fit into this?
It fits in a little bit, but not necessarily a hard and fast rule. But, you know, I'd say generally growth is when you're still adding to your portfolio. So once you retire, you know, I think you're going to be looking at the other three. Stable portfolio would be for somebody who's very risk averse, who has more money than they need, and they don't really need to get a competitive return. So most people would be conservative growth or moderate growth. And once, to me, it's the way we look at it isn't really age-based. Even if you're 80, it's like you don't want to necessarily get too conservative. You want to be sure you're going to have enough in your portfolio for your needs, but it shouldn't change much other than you're adding to the portfolio or you're drawing from the portfolio.
Isn't it has a lot to do with what we talked about last week? What's your balance sheet look like? What kind of cash flow do you have? How are you spending your money?
Yeah. What other assets? If you have a lot of pension plans, you could choose any of these. You're going to be okay. If this is what you're living on, and your spending needs are, you know, X amount, you may not be able to be as conservative as stable. You might need to be up to moderate. And you know, I'd say, you know, growth, we get uncomfortable when people are retired and they're in growth, but you know, anything moderate and down we're comfortable with. And these are things that you look at this on an ongoing basis. You evaluate it after, you know, a big change in the stock market. You evaluate it if the spending changes, if the health conditions change.
And that's one of the things that we talked about, is that you need to understand your tax bracket. Well, you need to understand your asset allocation. It's just a must know for yourself and for your advisor.
Yep. So this is breaking it down a little further. So this is a 60-40 portfolio, what we would call moderate growth. And again, Vanguard uses the same terminology, for example, and a lot of advisors have kind of adopted the same terminology of moderate for something that's close to a 60-40. Not everybody's exactly like that. But, you know, the core bonds would be, you know, short-term, they would be muni bonds if it was a taxable account. They would be corporate and government bonds if it was an IRA account. And then we, you know, emerging stock market stocks, developed market stocks, small, mid, and large, which we talked about, and 7% in non-US bonds to juice the yield on the bond side a little bit. So this would be, you know, a fairly typical breakdown for a 60-40 portfolio, where this is, we consider this well diversified. You know, we do have the largest allocation on the stock side to the US large cap, because that's the largest share of the overall stock market value is there. And, you know, a lot of clients will ask us, well, can I have, you know, Apple and Amazon and Facebook? And, you know, there's been a lot of discussion about how much of the S&P 500 those companies now represent. So if you have the S&P 500, you have a large amount of those companies already in your portfolio. So that's a, you know, kind of a good basic, and again, not too dissimilar from what you would get if you go to one of those Vanguard all-in-one funds. So the tax side of investing. So one of the things we talk about a lot here is we get clients saying, you know, I need income. I'm retiring now. I need income from my portfolio. And income may not actually need to mean income as in dividends and interest. You just need to pull money from your portfolio. You could also be pulling out capital gains from your portfolio, which is more efficient than income because capital gains come out at a lower tax rate. So we think people should always be looking at total return. So if you're in a moderate growth portfolio and we're, you know, projecting a 6 to 7% return, it may be that 3% of that comes from dividends and interest, and 4% over time is going to come from capital appreciation of the assets inside. And one of the things that you need to do if you're managing your own portfolio, and your advisor will do if you have an advisor managing the portfolio, is tax manage that. So as you're pulling out money, say monthly, there's an opportunity to rebalance, buy things that are down, sell things that are up and buy things that are down, or sell the things that are up to get you your return that you need. And if you're really looking at it that way, that like if you're pulling out 7% from your portfolio, it's likely that the taxes on that would only be like 3% of the amount you're pulling out. It's not the whole amount that's taxable.
Laura, how much do you spend on an annual basis, just a rough figure, just on financial planning software and information?
You would think as the CEO, I would have a pretty good feel for that. A lot. And we talk about our Bloomberg machine alone is like $2,200 or $2,300 a month. And we have the Morningstar advisor software.
Financial planning software.
$40,000, $50,000 on different
portfolio software.
Software add to that to produce the reports and everything. Yeah.
That's why it's hard for consumer because they don't necessarily have all this software to do tax harvesting, let's say, for example, at the end of the year, because, you know, they just don't know what is percentage is down and what is up, or to look at, you know, you can get, for a married couple, you can have $77,000 of capital gain and pay zero taxes. And so they don't have the cost basis and the market value handy. So it's well, I guess what I'm saying is it's well worth the 1% per year that you're paying a professional to keep, if they're doing all these things. If
they're doing a good job on the investment side, it's worth it just on the investment side. And then if you're getting any financial planning on top of that, it is a bargain. And, you know, we have portfolio rebalancing software. So if a client calls up and says, you know, I'm getting $5,000 a month out of my portfolio. Oh my gosh, this happened, that happens. I need $20,000 more more money this month. we weren't necessarily planning on that, though we have cash available, but we can run the software and look at, exactly where everything is on the day that we're going to sell, so that we can sell, if we need to sell, the most tax efficient things. And we also do that on the charitable side. It's great that we've got a lot of people all year have been doing it, and that's even ramping up more, saying, I want to give, X amount to charity. If you're giving $5,000 or $10,000 away or more, I always say cash is the worst asset to give. If you have any appreciated securities, you want to gift those assets to avoid the income tax on them, but you get the deduction of the fair market value. So it's a double whammy benefit to do that. And of course, our tax rebalancing software helps us figure that out very quickly.
So what do you mean by not everyone should own a muni? Tax-free? Shouldn't everybody have some tax-frees?
So depending on the rate, sometimes the corporate, if you're not in one of the top tax brackets, and I think we talked about it a little bit last week, you always think you're in that top tax bracket, but a lot of people are a zero tax bracket. You're going to get a higher net return, a higher yield being in corporate bonds rather than municipal bonds. So that's a calculation that needs to be run. And sometimes it switches year to year. So that, your tax bracket, there's a lot of tax planning that, or there's a little tax planning that can be done to kind of work your tax brackets year to year and bring in income up to a certain amount and then push off to another year. And so maybe you should be in munis 1 year and in taxable bonds another year. Mutual funds are a good way for a lot of people to invest. As I say, with the passive indexing side, we use exchange traded funds. One of the things we like about them is they don't make capital gains distributions. And that's not true of all exchange traded funds, but the ones that we use have never made a capital gains distribution. Whereas mutual funds will make a distribution whether you do anything or not, because if they sell things within that fund, you get a piece of that tax liability passed through to you with no say on that, obviously. So, and it's often a surprise, and sometimes it's big. Sometimes they've been as high as 30%. Like if you own a mutual fund that trades at $10 a share, in some years those mutual funds have distributed $3 in capital gains. And some people think that's a good thing, you get $3, but you don't really get $3 because the next day that share price is reduced to $7. So it's a net wash as far as what you own, but you get a tax liability of $3. So it's a negative to get a mutual fund distribution.
Is that more akin to active managers versus passive?
Yes, so that's active managers. And that's another thing with, another reason we like the passive management. But sometimes there's certain mutual funds we'll use in an IRA account where we don't have to worry about distributions. Occasionally there'll be mutual funds where there's few situations where we might want the active management. Investment location, or you might hear it called tax location, is choosing to put certain assets in like the IRA instead of your trust account. So investments that are going to have maybe very high returns, you might want to put in the IRA account where you're not paying any taxes on it. On the other hand, if it's an investment that might have a high return, but it might have a big loss, if you have it in the IRA, you can't take a deduction for that loss. So maybe that is an asset that should be elsewhere. If we have high income producing assets, some of the alternatives that we use tend to have high ordinary income taxable income. And so we would put those in IRAs where we can. So that's investment location, where you're not just throwing the same thing in the IRA as you are in your taxable account. You're looking at which one makes more sense in which type of account.
The super red flag for me is when I see a municipal bond fund in an IRA.
It's amazing how often we see that. Yeah, or an annuity. So half of annuities sold are in IRAs.
Yeah.
And you're putting a tax deferred inside a tax deferred, so you're not getting that benefit. And they've actually tried. There's been consumer groups that have tried to get that outlawed because it's kind of like malpractice. But about half of annuities sold are in IRA accounts. When
I was at Long Beach State University, probably 80% of the professors had annuities in their 403B program.
Yeah. So in the annuities, there's no capital gains. It's all ordinary income. It's LIFO, so that
First, the worst comes out
Then,
first.
yeah, worst first. So as soon as you can't pull out your cost basis first, it's all ordinary income, and then the beneficiaries don't get the step up in basis, and et cetera. So do you want to take any questions on investments, or should I keep moving through to the retirement?
Most
Keep
everyone,
going. Keep going.
Okay.
I would say most of our audience members are retired, but that's just a guess.
So, a couple questions. One of the questions was to the retirement planning category. Generally speaking, what percentage of your nest egg should be committed to guaranteed income, and what factors would you use to make that decision? I have to say that question, it's a good question, but it scares me a little bit. It sounds like something an annuity salesperson might talk about, because most people have a certain amount of guaranteed income, which is Social Security or a pension, or they don't have that. And then you can theoretically go buy guaranteed income, but then you're probably talking about buying an annuity, which isn't necessarily guaranteed income, depending on how it's structured. And there's always a trade-off for that. You can't get your money back, you can't get your money out. So Social Security is a form of guaranteed income. If you're managing your assets in your portfolio correctly, that shouldn't be a concern, because you don't want to be investing money that is at serious risk of loss or anything anyway. There isn't really a fixed rule of thumb. I think most advisors would agree with that, unless they're trying to say that you need your age in income real estate partnerships. That worries me a little bit. Yeah. Retirement planning, and this is, capital needs analysis, maybe for retirement, maybe not, but basically, what do you need? How much of a nest egg do you need before you can stop working? And then what do you need to earn on that to meet your needs throughout the rest of your life? So, what do you have? What do you need? How much more do you need to save if you're short? Impact of inflation, taxes, what can you spend? Social Security and Medicare. And just, I do think a lot of people in this audience are retired, but this was something I obviously I put together years ago, where I was brought into a 401k company, a pharmaceutical company, where everybody there were pretty high earners, but nobody was contributing to the 401k plan. And I'm just trying to tell them, you're making a lot of money, you're spending a lot of money, you really need to be saving some of it. And if you are trying to retire with $100,000 income, and ROR is rate of return, if you think you can get a 5% rate of return on your assets over the time between now and retirement, then you need to save $2.3 million. And that assumes that you're going to have 30 years of retirement to spend that money. And that's with 3% inflation. So $100,000 to live on, you need to accumulate 2.3 million if you can get a 5% return. So to accumulate that over 20 years, this is what I was telling this crowd. And if you think you're a very aggressive investor and you could get 8%, you still need to save $50,000 a year in your 401k or otherwise to get 2.3 million. And around here, 2.3 million isn't even going to be enough for some people. So, if you're young and you're working, nobody's saving enough. I would just say save as much as you can. Definitely take advantage of any employer plans to save it. And we'll talk about that in just a second. The rule of 72 is kind of a fun
Laura,
one.
let me stop you for just a minute, because it relates to all of these. It used to be that the argument was if you spent 4%, you'd be able to live forever on the money. Does that still apply? Great
question. There was just an article I was reading today about that 4% rule. 4% is probably pretty safe for most people. So, if you have $1 million and you spend $40,000 a year, you'll be fine for your life. But of course, it depends on whether that's taxable money or it's money that's in an IRA that you have to pay taxes on. And you're going to have to make different assumptions on obviously inflation and how that money's invested. I think for most people, you could probably push that to 5% spending, but it's dangerous. Those rules are dangerous because there's so many extenuating circumstances, again, depending on the asset. So But this gives you an idea, like a rule of thumb of what you're looking to say.
Let's see if I can do that. You mentioned this last week, and I put it in the materials handout.
Oh, are
And
you
it says,
spending
are
too
you
little?
spending too little in retirement?
Right.
And they, in the back of the article, they put observation on saving and spending. And they say saving is difficult for the young, spending is difficult for the old. So I don't know how many times I've have to encourage older individuals to spend more, to make a gift to the grandchild, to go on vacation. That's why you have the money. It's to be used.
Yep. And that's one of the things I think, I know just some of the satisfaction I've gotten out of being able to get somebody comfortable with that, showing the numbers. Like if you keep spending at this rate, your nest egg's just going to grow. And then your kids are going to get X, and they'll say, well, I don't want my kids to get that much. And I'm like, okay, then you can spend some more. I mean, I think if you really know somebody's looked at the numbers, looked at your tax situation, you could feel more comfortable and know what is reasonable, because it's hard to, it isn't a rule of thumb exactly. And to be sure that you're not going to run out. I mean, you obviously don't want to run out. And what you assume for life expectancy is a huge part of this. And we use now, for most people, 100 by default. And if people kind of have to argue with us to get a lower age. We had somebody this week who wanted to spend more. So she's like, I only want to go till age 90. And, she's only 60, I think, not even 60 probably. And we're like, no, we at least are going to 95. Well, we would compromise on 95. We wanted to do 100. She wanted 90. We're like, you just want to spend too much.
Yeah. That's the conversation that you need to have.
Yeah.
Those conversations are really good. I read the other day on Warren Buffett, 95% of his wealth was attained after the age of 65.
Yeah.
So, and this leads to the rule of 72. The magic of compounding is just unbelievable.
Right. So if you want to double your money in 10 years, you have to get a 7.2% return. And, if you say that moderate growth portfolio, that Vanguard, or just any 60-40 variation, that's about what you could expect. I mean, and that's pretty, that's very prudent investing, 60% in stocks, 40% in bonds, and you would expect your money to double in 10 years. You could catch a weird market cycle and it may not be exactly that, but that gives you an idea. That's reasonable. So retirement income sources, there was a question about 401k rolling to an IRA, that once you leave a company and retire, you can roll your 401k into an IRA plan, and then you can move it anywhere. You can manage it yourself or have your advisor manage it for you. I'm not sure exactly what the specific question was about that. Normally, while you're working, you want to max out all of these tax deferred savings accounts where you're getting a write-off up front. It doesn't make sense for most people to make after-tax IRA contributions. It's way more beneficial if you can get that upfront deduction. Otherwise, it might not make sense. Depends on how.
Laura, the question was more along the lines, would you recommend after you retire, whether to stay in your 401k or roll it over into an IRA account? And, usually your 401k is for the purpose of the employed and the employer.
Right.
And I believe if you roll it over into IRA, you may have many more choices, and you could more than likely diversify better and invest in a lower cost.
Yep, exactly. I was going to say definitely lower cost. And even though there's been a lot of regulatory scrutiny on cost in 401ks, they're still much higher than most IRA account costs would be. So, other sources of income, inheritance, that is a lot of fits into a lot of people's plans. And that's always hard to figure out how to calculate that in, especially if you're quite certain it's happening at some point. But some people are probably counting on that a little too much. And that's a good discussion to have also. So.
One of the things that we're dealing with today as well is how many of the younger kids are moving back in to the household.
Yeah. Yeah. And when your kid is home, you spend a lot more on everything, right? Food and everything else. I think the majority of people between 25 and 35 are living it with their parents or something. It's single people. It's a crazy number. So again, maxing out your company plans. Social Security, it's going to be here. There's certainly going to, most likely going to be changes going forward where there may be some earnings means testing. They may keep raising the age that you get your maximum benefits, but that's going to be pushed down to much younger generations. Anybody coming up to receiving benefits soon or already receiving benefits shouldn't have to worry too much. They will figure out how to fix this, but we get a lot of questions about when to take Social Security, and it depends on your health, what other assets you have, but generally the longer you can delay, the better. Every year you can delay up till age 70, you get, an extra 8% return on that. So it depends. And another thing, as financial advisors, most of us have Social Security optimization software where we can plug in different what if and break even scenarios to see when's the best time to take it, and husband, wife, and if there's some maximization that can be done there. And the ages, again, this is something that would be very easy for them to just bump these ages at which you get full benefits a little bit by a couple months, and that helps fund the system for quite a bit longer. So would not be surprised to see that coming at some point, though nobody's really wanted to tackle that one. This just shows how the more you earn, the less of your pay is going to be replaced by Social Security. Again, the age that people take benefits, and how much you might get at different retirement ages. And
they say that men take their benefits earlier than women.
Well, and that makes sense because usually the women are going to live longer, and so they'll get a higher amount if they live longer. And that's all taken into account in the software modeling. So again, maxing out the retirement benefits. I want to just, before we just touch on estate planning a little bit, I know we won't do too much because there's a lot more in-depth sessions on estate planning other than today. But I wanted to answer a question about a 529 plan. Once the student turns age 18, there's no maturity date on a 529 plan. You can keep it forever and use it for different kinds of school, trade school, some cases cooking school, and you could pass it along to another family member, or that child could just take the money at some point if it's not all spent. The penalties are not very onerous. It's usually still makes sense if you've used that account for a number of years. So there isn't really a maturity date on that at age 18.
How about, do you help clients out in the estate planning area? And if so, where?
In my conference room.
Okay, cute.
So we certainly do. We have a number of good estate planning attorneys that we work with very closely. Oftentimes we are in the meetings with the attorneys. Sometimes our clients want that, sometimes they don't. A lot of times it's helpful to have somebody translate estate planning documents. We have a process for reviewing drafts before clients sign. And, we know the clients usually pretty well and know what their intentions are. And there's lots of big decisions to be made. And everybody does this a bit differently. But
do you recommend, who in the family should be a fiduciary, or, because there's so many, or what happens to the money after death?
Yep. And I think, it's interesting because I've definitely seen in the last several years, most of the people we're working with seem to have had an experience with a corporate trustee. And has that ever been a good experience? No. Anybody who's had that? So I think people are very open to other alternatives other than a corporate trustee, and actually get somebody who cares about you. And, I think the conversation to use a private fiduciary is one that is much more common. I think it's becoming very accepted. A lot of the estate attorneys now will recommend that and be in favor of that, where you get somebody who this is what they do. They know how to deal with all these issues. I mean, anybody who's been the successor trustee for anyone in the family and had to settle all the estate and do everything understands that it's a job.
Yeah,
there's a lot to know about it.
Yeah, I usually highly recommend family members get a fee-only fiduciary financial advisors that can help out the family, because this is going to be maybe the first time they've received a lottery amount of money.
Yep. Yep. And
People
there's
generally aren't very good when they first get a lump sum.
no, and I think, there's that a common concept of that decision-free zone after a death, like don't make any decisions because you're not in a place to make decisions. And there's very few decisions that need to be made immediately, and give it some time and talk to several people to get a good
And you
team
can
to
keep
help.
away the wolves. Laura, we got 5 minutes left, or a little bit less than that.
So most people need a living trust. If you have any property, you can get a living trust for pretty inexpensive. If you have over 150,000 in assets, you may go through probate depending on how your assets are titled. But most people want to consider a living trust. It's the easiest way to deal with incapacitation, which is obviously the worst case, where you need somebody to help make decisions for you. So especially if you're single, that's something that's important. And just as far as estate and gift taxation, if you are married and you are fortunate enough to have more than 23 million in assets, this could be an issue for you. Single, about 11.5 million this year. Anybody else doesn't have to worry about estate taxes. And if you have over that amount, you definitely need to be working with advisors to see about potentially mitigating that. $15,000 is the annual gift exemption. You could give $15,000 to as many people as you want, and there's no gift tax return consequences, and you don't have to file a gift tax return, and nobody pays any tax on that. And I say the 529 is the best way to save for college. I say even if you don't use it or the parents pull it back, or it's still a pretty you only would pay tax on the earnings and a penalty on the earnings. So many people have used 529s very successfully. Just like everything else, there's fiduciary options and non-fiduciary options. Some of these are sold and you pay commissions. There's also ones that are kind of direct sold without commissions. You don't have to go to your state's plan. We use the Virginia plan, I think. I don't know. Mine got cashed out and used. So, one
of the things I usually recommend to individuals on the 529 plan, they want to, grandparents want to give kids gifts to the grandchildren. And the problem is with grandchildren, they can't hold money until they're 18. So I recommend highly to use the 529 plan and let the kids, or a Roth IRA, for the kids.
If you can employ them, figure out
exactly.
Employ them where I've seen where you have a business and the child's a model for your business on your website, and you have a photo that.
We got 2 minutes.
But 529 plans are great. Don't do the old uniform gift to minors accounts. Those are cumbersome and problematic.
Ooh, you got 10 recommendations.
So work only with fiduciary advisors, but do be careful of that term. That was one of the questions. The other folks are using that term. You just have to be sure that they have no broker dealer affiliations and they don't sell insurance. They still will call themselves fiduciary. They have to be 100% fiduciary all the time. And the ask first is a great way to go. Focus on asset allocation, not stock picking. Indexing is even better, I think. Don't time the market. Nobody does that successfully over time. Invest tax efficiently. Maximize contributions to retirement plans. Don't buy annuities. Don't borrow to spend. Borrowing to invest, that's kind of what a mortgage is, and that's a good kind of debt usually. But credit cards, don't borrow to spend. Use a 529 for college savings. Certainly have a will, probably a trust, and don't worry about the wrong risks. A lot of people are worried about the banks going under and getting the right things in the bank, or they're worried about the wrong risks, and the risks we've talked about are the right risks to worry about. Make sure you have a well diversified portfolio. You don't put all your eggs in one asset class basket. And again, work with the right professionals. So
Thank you, Laura. You did it.
Laura,
Yep.
scroll all the way back up to the beginning because I want your contact information up.
oh, and thank you to the sponsors.
Yes, I know, but they go the other way.
I'm what happened?
So all the way up to the top probably has your contact information.
Yep, and you know, last week several people emailed me with questions and to
Super.
get those living expense
Right.
forms and balance sheets. Happy to do that.
Because people are asking about how do we find a good financial advisor if we don't have the $5 million minimum. So
Yep,
just as a
and
note for that.
Yep,
There are
and
really
they-
good ones out there. Really
Yep.
good ones. Laura knows them. I know them. We'll help you find
Yep.
them.